let me ask you a question. What is the best way, the fastest way to determine the ability of a company to pay dividend? The dividend payout ratio, right? Well, it's a little bit more complicated than you may think. And today we're going to review 4 types of dividend payout ratios, and I'm going to explain you the pros and cons and how to understand them. My name is Mike Hiru, and I'm the founder of Dividend Stocks Rocks and Passionate Investor. I'm here to help you invest with conviction so you can enjoy your retirement. And if you want to enjoy your retirement, well, you don't want to bother to know if the company that you have in your portfolio will pay their dividends or not. And a lot of people will have this reflex of looking at the dividend payout ratio, and whenever it's over a certain amount, so sometimes it's like 80% or 90% or over 100, they just discard the stock and move on and look at another one. And this would be a grave mistake. So let's talk about the classic dividend payout ratio, which calculated using the dividend per share divided by earnings per share. So this is the classic method. It's giving you rapidly the ability of it's giving you basically how much the company make in profit, and then what is that percentage of dividend that is being distributed from those profit. The first problem that you're going to have with the classic payout ratio is earnings per share are calculated using general accounting rules. This means that if a company decided to write off some assets, to make an impairment, make a special charge for restructuration, or any other modification to their profits, well, it's going to affect their earnings. However, it's not going to affect their ability to pay the dividend. It's pretty much like if you buy a house at $400,000 and then 3 years down the road, the housing market is disgusting, we're in the middle of recession, and you call a real estate agent and you ask him, well, can we put our house on sale? And then he's going to say, yeah, sure, but you paid $400 and today you can only sell it at $360. So that's the price of the market. So when you do your balance sheet, you're losing $40,000 in assets in your net worth, but it doesn't affect your ability to pay your mortgage. So this is pretty much the same thing with the payout ratio. What is interesting here is to look at the past 5 years or maybe the past 10 years to see what's the trend look like. Some companies will maintain a payout ratio pretty much in like the 50% or 60%. It will be pretty much stable every year, while some others will be more cyclical, like in the industrial sector, for example, where you're going to have a company like 3M, which is a dividend king with over 50 years of consecutive dividend increase, still having payout ratio sometimes around 35%, sometimes around 60%, and even reaching 70-75% from time to time, depending if they're hitting a recession or not. Now, moving on to the next category is the cash payout ratio. If I have the choice between the dividend payout ratio and the cash payout ratio, I will use the cash payout ratio right away, because this one is telling me the ability of the company to use cash flow to pay dividends. So basically, it's really the cash in their bank account. The way it being calculated is the dividend paid divided by cash flow from operation. So obviously, like whatever the business is doing, just generating money, minus capital expenditure, often known as CapEx, and preferred dividend paid. So basically, you're looking at how much the business is generating in cash flow, and then minus all the investment that is being used to either do R&D, innovation, acquisition, to fund any kind of projects that will make the company grow in the future. Having large CapEx is a good thing because it means management has growth vectors and they want to build a better business for you, for shareholders, over the long run. The problem is when you look at the cash payout ratio and you have an important capital expenditure, like let's say just major acquisition, or they want to build another factory or something like that, and they put like billions of dollars into it, then you'll have sometimes high cash payout ratio or even a negative cash payout ratio. And then you may think, oh, well, company might cut their dividend. Well, the thing is, most projects, most acquisition are being financed through debts or the issue of more units or more shares, depending if you're talking about a REITs or a company. So you have to take that into consideration. So whenever you see a very high payout ratio or negative cash payout ratio, go back into their quarterly earnings and look at what the project look like, and they will likely increase their debt. And at that point, they will be able to pay their dividend with their cash flow and finance their capex with more debt or more shares. Obviously, dividend payout ratio and cash payout ratio are used for what I would call classic companies. So basic like businesses like Starbucks or Microsoft or Coca-Cola, Procter & Gamble. Those businesses that have like regular revenues and then earnings, and it's easy to use like basic numbers that you can find pretty much everywhere. When it gets a little bit more complicated is when you get, let's say, pipelines or some utilities that are capital intensive and earnings are not going to work very well. And as I mentioned, cash payout ratio may be out of bounds because they have huge capex. In those cases, the company itself will likely use distributable cash flow payout ratio. So it's the dividend per share divided by the distributable cash flow per share. The problem with this one is it's almost impossible to get it from any financial website. I personally use YChart, but they don't provide it. I don't think that Seeking Alpha or Yahoo Finance will provide it as well. So it's not. Basically it's a number that is being calculated by the company itself. It gives you a very clear picture of the ability of the company to pay. The best example that I could think of is Enbridge. Right now, Enbridge has ridiculous payout and cash payout ratio, but when you look at their DCF payout ratio, it all goes down to like roughly 65%. So all of a sudden, the yield makes sense, the dividend growth makes sense, and everything is good. But when you look at payout ratio near 300%, that is completely ridiculous, right? The thing is, you have to go into their quarterly earnings report and then look at how they calculate it. They usually have a full slide, so you can go in events and presentation, and then you'll have a complete slide explaining in details how they reach that distributable cash flow that is available for dividend and how they make those calculations. So it's clear, but it requires a lot more time. And if you want to put a trend for 5 or 10 years, then you will rely on the business generosity of making those graphs, or you have to do that monk's work to go back into all the annual statements and take down those notes and use an Excel spreadsheet. Now, for my retirees, one of your favorite stock type is probably REITs because they are very stable. They usually offer a higher yield, and because of their tax structure, they are required to distribute at least 90% of their profit. So using payout ratio and cash payout ratio will not be of any use. Actually, those are metrics you will find them on financial website, but they're completely irrelevant, and there's no link between the funds from operation or adjusted fund from operation. So we're talking about FFO or AFFO payout ratio. There's no link between the others. So this is the number that you have to look at. Then again, it's being calculated by the REIT. It's usually provided in a very important and detailed way. You'll get both the FFO and the AFFO numbers. What is very important here is to make sure to look at the number per share or per unit instead of looking at the overall funds from operation trend. A lot of REITs, especially in the past 10 years, have grown a lot by acquiring new properties or renovating, and then they increase their revenue, they increase their funds from operation, but the way they did it is they issued more units. So the more units they issue, the more money they have in their pocket to grow, but also the more money that they have to pay in dividends. So let's say they had at first 1,000 units and pay $1 in dividend per year. So the first year, it cost $1,000 in dividend. The next year, they decide to issue 200 shares, 200 units. Now they go up to 1,200 units, and you guessed it, if they still pay $1 per dividend per unit, they'll have to pay $1,200. This is why you need to look at numbers per share. And if a REIT was not able to increase it over the past 5 years, they will likely hit a big road bump right now with the recession. And those are the REITs that are more likely to cut their dividend or stop increasing them. So those are the small tricks that you can use to see, yeah, I like this REIT. It's paying like a 7% yield. It's a little bit high. That's a red flag. You have to go a little bit further. So let's look at the FFO payout ratio. And now you're looking at it and now it's over 100% for a few quarters. Then that rings the bell. Say, you know what? Chances are the next time they have a problem, they will have to cut their dividend. So 1 quarter is not too bad. 2-3 quarters, there could be an explanation. Like 2020 is a very good explanation for lots of companies to have high payout ratios. But in general, if they are not able to modify and improve their situation after 3 or 4 quarters, this is a red light. And this is a sign, my friend, that they will likely eventually cut their dividend. Think about it. A lot of research will tell you, oh, dividend cutters are beating the market, but most of them, they will look at the stock price return once the dividend cut is being announced and not 6 months or 12 months before they cut their dividend. Usually the market is pretty smart. They look at it, they see it coming, and then they start selling the stock. So you'll see the stock shares price going down for a while, and then the yield is higher up. The payout ratio is through the roof, and then you get your dividend cut. So it's really important to follow the trends, make sure you understand the context behind the numbers and how it has been calculated, and you will be able to avoid a lot of dividend cuts. I'm going into a lot more deeper calculation and giving you more tricks to avoid this dividend cuts in my next webinar. Don't worry if you don't see this video live. You can still register to a webinar, which is right there in the link description below. Register, you'll get access to the replay right away. We're going to go through all types of dividend payout ratio. We're going to give some explanation in terms of calculation, and I'm going to give you some extra tips to avoid dividend cuts during the next recession. Most importantly, protect your dividend. Make sure that they always increase. And until my next video, stay invested.